Hello and welcome again to the Market Prospects 2018 series, our 33rd year of providing expert and timely market and related information to prairie farmers. I'm Dr. Eric Michaels, Assistant Professor in the Department of Agricultural and Resource Economics at the College of Agriculture and Bioresources at the University of Saskatchewan here in Saskatoon, and I'll be your host today. Today, for our second Market Prospects interview of the 2018 year, we are pleased to speak again with Dr. Robert Johansson, Chief Economist of the United States Department of Agriculture, who will provide us with the USDA's perspective on grain and oilseed production in the United States. Dr. Johansson is in the USDA studio in Washington, D.C. Dr. Johansson's appearance on Market Prospects again this year continues many years of cooperation between the USDA's Office of the Chief Economist and the Market Prospects Project in this annual series of 2 interviews. We are fortunate to be able to have this conversation with Dr. Johansson and benefit from his expert commentary and analysis. Welcome, Dr. Johansson, and thank you for taking the time to provide us with this Market Prospects interview again in 2018.
Oh, thanks so much for having me. It's my pleasure. Always exciting time of year when we're looking at the new year for our plantings, and happy to discuss what we're thinking about right now.
Yeah, it's always exciting when the new year comes around and we're able to take stock of what happened last year and what's going to happen in the coming year.
That's right.
In our previous interview, you provided an overview of current and expected global supply, demand, and prices for grains and oilseeds. How are current prices and stocks in these crops and expectations for next year affecting the U.S. farm sector?
Well, certainly just this January, USDA increased our ending stock estimate for U.S. wheat to 989 million bushels on lower than expected feed and residual usage. Ending stocks are currently below last year, but still are pretty high, pretty burdensome, I would say. The U.S. farm price for wheat is going to be projected here at $4.60 a bushel, and that's at the midpoint. We've got obviously a range around that. That's modestly above last year's $3.89 a bushel. Still pretty low, though, from a historic standpoint. Current and projected oilseed supplies have generally increased faster than global demand for protein and veg oils. That's left prices at a relatively low level compared with the past 10 years. However, I'd say that prices for oilseeds are strong relative to other crops as global protein demand has continued to exceed global demand growth for wheat and feed grains. So as a result, I would expect producers here in the U.S. to expect to favor oilseeds in their planting decisions.
Could you speak to the situation of U.S. grain and oilseed producers in terms of farm income, debt levels, interest rates and land values, and rental rates, and how might the new tax bill recently passed by Congress affect those?
Overall farm income in the U.S. Has come down significantly, probably about 40% over the last couple of years. So it's significantly lower than we had back in, say, 2012, 2013, 2014 time period. We're sitting in the sort of the $65 to $70 billion level for net farm income. Of course, that's across all commodities. So even though farm income has come down, when we look to debt to asset ratios, overall for the sector, debt to asset levels in the United States for farm production is sitting still at a pretty low level from a historical standpoint. I don't think we've hit 15% yet. As a comparison, back in the 1980s, we were pushing over 20%, 22% debt to asset ratio. So right now, still a strong financial basis for farm production in the U.S. We do know that will vary by sector, however. When we look across different sectors, we do know that if we say, for example, about 1 in 10 U.S. farm businesses are in a situation where debt to asset ratios are above 0.4. So in a more highly leveraged situation than you would see for the other 9 out of 10 farms. If we look at wheat farms, for example, in the U.S., we know that almost 1 in 5 wheat farms is in a more leveraged situation of having debt to asset ratios of above 0.4. Of course, when we see farm income come down and prices come down like we have, we would expect to see rental rates come down as well. And we have seen rental rates come down significantly in some areas, and I would just say flatten out over this year going forward. We have seen almost double-digit declines over the last, say, 3 or 4 years in many regions. But again, it looks like we've found the bottom in a lot of places. So I would say as long as prices continue to stay at these levels or slow growth over the next couple of years, I don't think we'll see any real big changes in land values. In fact, I think there's been a lot of commentary about in the U.S. on why land values and rental rates have not come down almost as much as income has. A good reason for that, I would say, is producers had a good amount of working capital on hand following the boom years that we saw in 2013, for example, and a lot of that cash on hand has enabled producers to continue to bid for good farmland when it comes up for sale. That keeps prices high. I guess I would just say, that being said, we have seen that working capital levels in the U.S. come down also as farm prices, or as income has come down and as commodity prices have come down. So we've seen that high level of cash on hand come down about 70% over the last 4 years as well. Of course, we know that debt levels are increasing on many farms. Obviously, as I mentioned just a second ago, assets remain relatively high in value, so overall debt to asset is still in a stable situation. But the amount of debt that producers have taken on to help with operating costs, for example, and also to buy real estate, has increased pretty substantially. We're seeing relatively high levels, levels that we may have actually even seen back in the 1980s. But the big difference being is right now, obviously, interest rates are so much lower than they were previously, still sitting at very low levels, so credit remains relatively cheap. And so that high level of debt isn't necessarily affecting the bottom line for a lot of producers. So again, there are some troubling signs. We have seen maturity rates increase. Interest rates are starting to go up a little bit. Some repayment issues have arisen in some of the lending banks across the Midwest. But by and large, we're still in a fairly stable situation. Prices for non-irrigated cropland, some wheat land, has been coming down. And we've seen, I think we talked about earlier last week, about how oilseed demand has kept oilseed prices high relative to feed grains and food grains. And so we might expect to see some loss in wheat acres this year to soybeans, for example. And we have seen that happen over the last few years. We've seen wheat acres going out of a lot of the plains states being replaced by corn and soybeans. So that trend will likely continue going forward, given the fact that soybean prices in particular remain strong relative to wheat prices.
One other question relating to that would be, would the passage of the recent tax reform bill have any effect on those factors, or do you think there would be not much of a change in that, other than maybe an incentive to sell your grain through a co-op?
Certainly the new tax reform bill is still undergoing some evaluation. And we haven't completed a full analysis of the bill yet. I think it's, by and large, the tax reform package will benefit a lot of farms, most farms, in fact, and we would help them with their having a higher amount of working capital on hand due to the fact that their tax bill is likely to go down. But I don't think we would point at any particular factor that would say that the tax bill is going to affect farm income all that dramatically as compared to commodity prices. We would expect those to still to be the main driver in what farms are seeing for their income.
What are the acreage and current conditions of U.S. winter wheat crop, and what are some major factors that will determine total production potential for that crop?
Well, this past January, I think we talked a little bit about, maybe last week, USDA reported that winter wheat acres, planted acres, was almost unchanged from last year. Now, down a little bit, about a little less than 1%, down to about 32.6 million acres. That's down, as I mentioned, about 88,000 acres, so not a lot. Nevertheless, we would still say this would be the lowest winter wheat plantings in the U.S. since 1909, so pretty dramatic the amount of wheat acres we've seen leave production overall, as I mentioned, not that different from last year. Winter wheat conditions in those areas are at the lowest level in several years, however, due to the dry conditions in the plains. I think I talked a little bit about the drought earlier. And we have seen reduced snow cover in a lot of areas, and that's raised some concerns about winter kill, although the extent of damage to the wheat crop is obviously at this time very speculative and won't accurately be able to be assessed until the spring. As we know, the last 2 years, for example, we got beneficial moisture in the spring, and that was key in raising those yields to their highest and second highest on record in 16 and 17, respectively.
Earlier, you mentioned the corn and soybean price ratio, and in terms of how that helps farmers decide how acreage allocations. Are there other factors that American farmers use to decide whether to grow corn versus soybeans, and what is expected for acreage allocations between these crops in 2018 and beyond?
You know, obviously that corn price ratio is something, corn to bean price ratio is something I'll mention in a second, but obviously returns is expected returns, I would say, is what producers are looking at. Risk and rotation are also a part. As I mentioned, we have a corn to soybean price ratio for harvest right now, for futures harvest at 2.5 at the moment. Last year we had a similar ratio, and we had a jump in our soybean planted acres. I don't expect that we'll see the same jump this year despite that ratio. There are some rotational issues and other risks that are probably going to come into play. For example, we know that most rotations here in the U.S. are a corn-bean rotation, so oftentimes you do see this complementary planting change back and forth between corn and soybeans. Soybeans continue to be competitive in the U.S. We've seen the combined area of corn plus soybeans growing over time. The share of the crop between the two approaching 50-50. So I would expect going forward we're going to be pretty close to that parity level of plantings for the next year's crop.
Pulse crops, especially dry peas, lentils, and chickpeas, and flax are important components of Western Canadian agriculture. What expectations are there for growth in U.S. production of these crops, domestic use, and export of these and competing crops?
Well, we know we have the area to expand our pulse crop production. Our expectation is for growth in the area of crops such as chickpeas, dry peas, and lentils in the next decade. We're obviously a much smaller producer than Canada, which would face the same issues. Area we would need to bid away from canola and wheat, and the primary export market for both Canada and the United States would be India. That does pose export risks given India's less than certain environment when it comes to importation of food commodities. I would just say that certainly it's been a growing sector in the United States. We expect it to continue to grow, but there is a certain amount of risk involved with selling to the Indian market right now.
Moving on to livestock, what is the situation and outlook in the U.S. livestock industry, especially in terms of consumer demand for meat and the impact on beef production, prices, and imports?
Well, red meat and poultry demand is expected to remain robust in 18. Of course, that's fueled by our improving economy and the economy overseas, and increasing supplies of product. Wholesale beef prices and prices have been above year over year this January, despite an approximately 3% higher beef production in the first 4 weeks of this year. Likewise, we also see in pork production, it's about 1% above the year earlier in the first 4 weeks. Wholesale pork value averaged just above what we had last year. And though production is expected to increase during the year, in both cases we're expecting the pressure prices to come down with that production. Consumers are expected to take advantage of those lower prices. And per capita disappearance of meat in the U.S. is forecast slightly higher than we had previously. So again, we're generally expecting all meat products as well as dairy to increase into 2018. likely to see record high production levels for both those, for beef, pork, chicken, and dairy production. Prices, though, are likely to head the other direction, like we often see, and so likely see lower prices for those commodities relative to 2017. Obviously, we're going to be looking to export a good amount of that, but U.S. consumers are continue to increase their consumption of most of those products as well.
You mentioned earlier that this would be the last year of the 2014 Farm Bill. Mm-hmm. What progress has been made on the development of a new Farm Bill, and what are some major initiatives being debated?
Well, it's a good question. It's always all the last Farm Bill, there was a lot of changes made. We moved cotton out of the one part of the Farm Bill into another part and made some new crop insurance products available to cotton producers. Similarly, we changed our dairy program to make the safety net for dairy producers a little bit more based on insurance principles. And in addition, we expanded a good number of insurance products to cover a lot more specialty crops across the United States, a continued advancement in that part of the Farm Bill. And of course, we replaced a lot of our direct supports with more countercyclical types of programs. So looking at the new Farm Bill, I think producers are interested to see, obviously, improvements in all areas, but I don't hear a lot about major changes to a lot of the Farm Bill provisions. We do see a certain amount of discussion around a couple key areas, one being the producers are keen on improving the margin protection plan for dairy, margin protection program for dairy, which hasn't been as effective at cushioning producers from lower dairy prices. Similarly, we're expecting to see some potential movement on how the Farm Bill addresses cotton. There's been a lot of discussion about whether or not the new insurance program for cotton producers was effective, or when prices have come down substantially from where they were during the last Farm Bill discussion. And lastly, I would just say that there are also changes anticipated for some of the conservation programs. There's been discussion about some of those provisions that would potentially increase the number of acres that we might see under some of our easement programs. But again, with any of those changes, the folks that are putting together the Farm Bill in Congress are certainly trying to do that, trying to make improvements while trying to stay close to the budget that they're working under. A lot of our Farm Bill programs feed into a larger budget discussion in Congress, where we need to start balancing budgets, making sure we're not running deficits year after year. And so it makes it hard for improvements to be made to certain programs when you don't want to be taken away from other programs that may be working well. So it's a difficult task that the legislators have to do every 5 years here in the United States. And certainly USDA is providing technical expertise to help them, work through some of those issues. And then, of course, it'll be up to us to implement the new programs once Congress enacts a new Farm Bill.
Which 3 or 4 factors in the U.S. agricultural economy would you suggest Western Canadian farmers watch most closely in the coming months as price indicators for grain and oilseed markets?
We'll continue to watch. I'm sure your listeners will also appreciate the amount that the Chinese demand for oilseeds has been driving a lot of those prices, and the price strength for soybeans, for example, translates into probably higher planted acres to soybean and other oilseeds, both here in the United States as well as in South America, Canada, and in Europe. So we're likely to see a good deal of interest in following Chinese demand for a lot of products, including centered mostly around oilseeds, but of course, they're a strong destination for a lot of other feed grains as well. So that would be one thing, just to watch their economic growth prospects as China continues to see more households moving into the middle class. We'll continue to see demand for proteins, meat proteins grow in China, and that will continue to fuel strong demand for oilseeds. I would also look at petroleum prices. We've seen a decoupling of the petroleum price and agricultural commodity prices that had been strong earlier during the late 2000s. That was driven for a good part due to the linkage between oil prices and renewable fuel production growth. Obviously, that we're at a pretty mature point right now, at least in the U.S., in terms of biofuel production. But as oil prices go up, that does affect the value of the dollar in a lot of countries. It also does signal continued expansion in global GDP levels, and so higher oil prices is probably good for signaling increasing demand, but at the same time, it also may, from a Canadian perspective, mean a stronger Canadian dollar and something that Canadian exporters are going to have to address or to worry about as they're looking to export more.
Along those lines, could I ask you, I've been reading I mentioned that I follow the Farm Doc folks at the University of Illinois, and one of the things Scott Irwin has been talking about is a price cap on RINs. That the renewable market is managed by the EPA, I believe. Is that correct? And how would that if that would happen, how would that influence the grain and oilseed market?
Oh, yeah, that's a good question. I haven't read that Farm Doc piece. Familiar with the issue, though. There is the renewable fuels standard is a rulemaking here in the United States that EPA, the Environmental Protection Agency, is responsible for. That mandate to blend biofuels into the fuel stream has been increasing over time. As I mentioned earlier, we're at a pretty mature point at the renewable fuel standard right now. But nevertheless, the compliance mechanism for the renewable fuel standard, and this gets pretty complicated, your growers and listeners may be familiar with this or not, but certainly there's more information available either at the EPA website or you could point them to that Scott Irwin Farm Doc article. But one of the ways that we track compliance here in the United States with that renewable fuel standard is through these renewable identification numbers, or RINs, which refineries are required to turn in to EPA to demonstrate that they have met their blending obligations. And so those RINs essentially are an indicator of how difficult it is to meet the mandates. So the more difficult it is to meet the blending mandates, the more expensive those RINs become. So the refineries have been suggesting that RIN prices are too high for them, and so they've been asking lawmakers to figure out a way to lower those RIN prices. So one way you can do that is to cap the price of RINs, and sort of at some level. And we do that a little bit for some of the advanced biofuel mandates that we've got, but this would be for just the standard renewable fuel categories such as ethanol. By capping those RINs at a certain level, that essentially means that you're lowering the amount of fuel that needs to be blended into the fuel stream, lowering that obligation and bringing prices down. So on the one hand, the refineries like that idea, and on the other hand, certainly the constituents that produce ethanol are against that. And I think generally you have the agricultural interests that are selling to ethanol producers or biodiesel producers that would like there to be continued growth in their markets, and so that makes it difficult for them to come to a compromise on that issue. But again, it's one of those complicated discussions that make it difficult to cover in its entirety during a television interview.
That is very true. Well, thank you very much, Dr. Johansson, for taking the time to provide our audience with your insights into these important agricultural issues again this year. We appreciate the long-time cooperation of the Office of the Chief Economist with the Market Prospects Project here at the University of Saskatchewan in producing these annual interviews, and we hope that we can speak with you again in the future.
Well, thanks very much for having me on the show. I look forward to joining you next year at this time. Certainly encourage your listeners to check out our Ag Outlook Forum website, where we'll be listing the speakers we'll have that will cover a number of the issues we talked about today in probably much more detail and much more exciting depth than I did just now with you. Right now, of course, we don't have presentations up since that conference won't take place for another couple weeks, but we generally get the presentations from all the presenters. We populate those onto our website at USDA Office of Chief Economist. And so for those viewers that are interested in hearing about the prospects for the Argentinian or the Brazilian crop this year, or for Chinese demand, or for any host of other issues, such as perhaps even trade negotiations, you can send your listeners to that site to find out what the most recent USDA and outside, it's not just USDA that's presenting at these, it's also oftentimes even folks from Canada will be joining us there, and other countries providing their viewpoints on these issues, as well as the private sector here in the United States. So at any rate, again, thanks for having me on the show, and look forward to chatting next year.
Thank you very much. Have a good day.
Thanks, Eric. Bye.